example of the revenue ruling, but like most things, if you go, when I say most things in tax at least, it's what you see, or by way of example, that you hopefully pick this stuff up, or at least that's my aspirations and the author's aspirations. So let's take a look at the problems on page 303. We have Hill Corporation organized with two classes of voting stock, Class A and Class B. Each class of stock has equal right to Hill's assets and earnings and profits. Frank owns 100 shares of Class A, and Faye and Joyce each own 50 shares of Class B. Right? And what I did was I just drew a little chart here for my own edification, just to make sure. We have two classes. We have Frank, and we have Faye, and we have Joyce. And we're told that Frank owns 100, and Faye and Joyce each own 50-50. 200 shares outstanding. Everyone there? Now, it says assuming Hill has ample E&P. Now, there's a hint there. If the authors are putting ample E&P, they're trying to suggest to you, DePico, what do you think they're trying to suggest? Dividend, right? Is that any distributions here, if it doesn't qualify for non-tax treatment, chances are 301C1 will apply, right? So, says determine whether the following distributions are taxable under 301 or excludable, right, under 305A. So remember chapter 4, guys, or I should say, excuse me, chapter 5, when we spoke about redemptions, remember how that chapter we bifurcated and said in chapter 5, is it truly an exchange? Or alternatively, if it doesn't qualify for exchange, it's going to be treated as a non-taxable distribution, right? There's somewhat of a similar theme here. Is it going to be non-taxable, or are we back into our chapter 4 non-liquidating distribution? So, a pro rata distribution of non-convertible preferred stock to both classes of shareholders, okay? So, this is our Class A, Class B. We're going to pro rata, not non-pro. I don't know where I got that from. A pro rata distribution of non-convertible preferred stock. So we're going to get preferred stock on common stock. Everyone agree? We're getting preferred stock on common stock. So in that particular instance, is that taxable? Is that non-taxable? Wafa, taxable. Paul, taxable. Say again, yeah? B3? And do you agree, Paul?
Yeah, B3, yes.
It's important. And Fatima, you say what?
B3.
B3? Fatima, Wafa, you agree? Paul agree? Dion agree? Now, pretend for a moment, because it's good to pretend when you're doing tax, is that are you, Paul, and Dion, you're the three shareholders here, right? Wafa, you're Frank. I'm sorry, you know. You can be Joyce. You can be Joyce. Or Faye. Yeah. All right. All right, so Michelle, you're going to be Faye. Wafa's Joyce. And Paul, you'll be Frank. All right? Everyone have their character? Okay? And Michelle, are you taxable or not? Wafa taxable? And Paul, are you taxable? You're saying you're not. Wafa, you're going to stick with it now that we're role playing? But Can I say something, Wafa? You're focusing on the words, but I don't think you're not focusing on your inner self. Okay? And if you pause for a moment and focus at your inner self, hold on, Wafa, you're so focused on the words. Okay? By the way, do you guys, the meditation quote, okay? Did you guys, I thought that was a good quote. You see that every day? See, that was new to me. I was like, whoa, that was nice. That's how she ended her session. And I know meditation and me seem like an oxymoron too. But now that you feel that inner self, Wafa, do you feel any different before and after when you get that preferred stock? Without focusing on the language of the code. Just close your eyes, Wafa. Okay? Don't look at the code. Wafa. Okay? A little, little meditation here. All right? Perfect. I like that pose. All right? She had the yoga pose if no one saw that. So, Wafa, there you go. Okay? Just like that. Everyone see? Wafa's like, taking it all in. Wafa, as you're taking it all in, you feel any different before and after you get that piece of paper? Close your eyes again. You're still finding yourself? Paul, you're finding yourself? Do you close your eyes? Do you feel any different?
I feel different.
So if you feel different, you're going to feel taxable. Is that right, Dion? No? Why not?
You need to forward distribution, so that's why there's no exclusions.
Allie's shaking yes. It's like you got another piece of paper, right, Allie?
Yeah, in the end.
You just have another piece of paper.
Share of everything, so if they got to vote on something.
Yeah. I mean, the pie is going to still be divided the same way, Wafa. What are you looking at? And Fatima, B3, B4, it doesn't apply here. Explain how you see how one of those exceptions apply. And I'm just saying, don't get fixed. Take a moment, whether it be for an exam or a client, and say, do you feel any different? Yes. Say again? We're going to get to that. Hold that thought, because that's going to be important. But there are questions. So your answer to question A necessitates the application of what code section? What code section gets triggered if 305A coupled with, hold on. Christina, you got through the vending machine peanuts, so you should peanut butter and jelly would be 307. Okay, there you go. 307, right? 305A, right? Connects you to 307. Agreed? And we would allocate that basis based on fair market value. All right, so your answer to question A, not taxable, 307 divvies up the tax basis, right? Question B. A pro rata distribution of Class A on Class A and Class B on Class B. The Class B shareholders also are given the option to take cash in lieu of additional Class B shares. Joyce exercises this option. Okay? So, Boo, Adele, Irma, you want to role play? Okay, Maboo, there's only one male here, Frank. Irma, you be Faye, and Adele, you be Joyce. So, Frank, Maboo, taxable or not? No, you know what? I'm going to skip you for a moment. Let me come back to, hold on, give me a second. Joyce is Adele, right? Joyce, taxable or not? She's easy. I hate, well, I better. Okay. All right. Skip that line, but you get my message, right? No one has that on tape, right? That's the problem. Your light is on, Waff, is what you're saying? All right. I hear you. All right. So, you're taxed, you got cash. Irma, taxable or not? So why? So you're going to close your eyes now too? Are you taxable or not? Don't say the word guess, and just if you say it is, you got to tell me why. What code section makes it taxable? Because taxpayers don't want to hear it; they want proof. Show me why it's taxable. Alice, what would you point to? It's not a trick question. Sharon? 305B1, right? What does that say? If you have a choice, right, Irma? You could take cash or you get the stock. You chose the stock, but you could have had the cash, right? Everyone agree? That's tantamount to taking the cash and then buying the stock. Absolutely taxable to Irma. And in this case, Irma's fed.
What would you say Joyce's taxable? Would you say 61?
Yeah, just 61, or 301C1. Mm-hmm. Now, Mabu, you're Frank. Taxable or not? Mabu? Say again? So what would be your authority? What would be your authority if you say it's not taxable? Okay, if it's not taxable, it's under 305A. Christy, would that be right? So you're saying it would be taxable? You would or would not?
Would.
And it's so under why B2?
Because someone took cash and he's taking stock.
No, that's dealing with redemptions, okay? But it's taxable, but for a different reason. Under 305B1, if you look at the regulations, guys, 305-2A. 305-2A says that essentially, I'm going to paraphrase -2A, 305-2A says that essentially if any shareholder has an election, then it's taxable to all the shareholders. And Christy, that may be a backhanded way to get you under essentially B2, but it keeps it under B1. All right, so Mabu, you would be taxable. Why? Under the authority of the regulations under 305-2A. And -2A5 specifically says whether part or all the shareholders have the right to the election. So even if only one person does and the rest don't, it's taxable to all because it would fall within B1. Kevin, someone else had a question? All right. So we're good? Question B? taxable to all. And what that means is they're taxable as a distribution under 301c1. This company has plenty of earnings and profits. It's all taxable as dividends to them. Question C. A pro rata, not a non-pro rata. A pro rata distribution of Class A stock in Class A and a cash distribution on Class B. So in this case, Edwin, you be Frank. In this case, Fatima, Fanta, you want to be Fatima, Faye, Fanta, Joyce. So Edwin, are you taxable? Question C says, Class A, a pro rata distribution of Class A stock on Class A. So, Edwin, you get Class A, and Fatima and Fanta, you get cash. Oh, Fatima, Fanta, do you have tax? Okay. You say you got cash, you got tax, right? What's your authority? Well, let's slow down. I'll ask that in a second. Edwin, are you tax? You got stock on stock. You do or don't? You think so? What would be an authority? Israel, do you know what his authority would be? Where? Carolina?
305
B2. 305 B2, right? Where some people get cash and other people get stock, it would be taxable. So even though Edwin got stock, he's subject to tax. Agreed? You got to look at all the shareholders. There's implications to each. The reality is, when Edwin wakes up in the morning, he's feeling stronger, at least with his relationship to that corporation, right?
So the authority for all three is 305 B2?
Yep. And that gets us to the world of 301. Assume that Class B is non-convertible preferred stock which pays regular cash dividend. Okay, so it pays cash dividends. And Hill distributes Class B stock to the Class A shareholder. Okay, everyone got that? So Frank is now going to get the non-convertible preferred stock. Okay. In this particular instance, is this taxable? Okay, is this taxable? So we only have one Frank. Andrew, you want to role play? You want to be Frank? Taxable or not? And if so, why? And Brian, see if you agree. Can't be B4, right? It's not a you only own common B4. And when you say B3, there's no simultaneous distributions of common and preferred, right? It's only a distribution of preferred. Do you feel stronger in the morning, Andrew? At least with respect to the corporation. You don't. Brian, should he? Class B is just what it was before. It's not going to change. Okay, why is that? When you say it's preferred stock, assume Class B is a Class B non-convertible preferred stock which pays regular cash dividends, and Hill distributes Class B to Class A. Now, what's going to happen? What do we know about preferred stock generally, guys? But that it gets preference as to distributions and liquidation, right? And there's limitations. It gets capped as well. If there's $100, if Hill has $100 to distribute, okay, and the first 100 has to be distributed to the preferred shareholders. Normally, Fay and Joyce would share equally in that. Everyone agree that if Frank was the one common shareholder and Fay and Joyce were the preferred shareholders, they would get the first, under the preferred stock rights, they would get the first X dollars. In this case, we said 100. Suppose Frank can join the party, meaning Frank now has some shares of preferred stock, and there's now $100 to be divvied up. Ah, guess who joins the party, Andrew? You do, right? And when you join the party, guess who gets less? So do you feel stronger in the morning? You feel stronger. And the reality is, preferred stock pays dividends or cash, right? If you look at 305B2, it talks about where someone gets the receipt of property by some shareholders, which is their cash distribution on the preferred, and an increase in proportion in interest by other shareholders. So this would, even though it doesn't look like it neatly, this would be under B2. B what? You can't stop there. Say again? It would be under B2. You got to be specific. You can't just say B. Okay? Taxable. Okay. Question E. Same as D, except that Hill distributes a class of non-convertible preferred stock which has rights and assets and earnings, profits subordinate to those of the existing Class B, that is his junior, to the Class A shareholder. So once again, Andrew, now you're going to get this. Are you subject to tax? And Brian, should he be subject to tax?
Yes.
Why? Well, there's not a distribution of common and preferred, Andrew. You can't be there. Brian, is this taxable? Close your eyes, think, ponder, meditate. And if not, why not? All right, when there's $100 to be distributed, Frank can't, in other words, they have not been diluted, right? They still get the same preference. His interest is subordinate, right? So he shouldn't, Andrew, you shouldn't feel any stronger in the morning vis-a-vis your relationship. You have not augmented increased your power in this corporation. This would not be subject to tax 305A. Now, both for question D and E, guys, there is an example in the regulations. Again, the authors here are not being creative. 305-3E, example 3. I'll repeat. 305-3E, example 3. In both instances, for question D and E, the authors did not go far afield. They just paraphrased the examples in the regulations. And in question D, it would be subject to tax. Question E, it would not be. 305 would apply, and Christina, 305 applies. What code section applies? 305, 307. Thank you. It's not taxable. It doesn't fall within the scope. And here, Fatima, you can say it doesn't fall within the scope of 305B. Here you get permission to say that. But if it does fall, you got to say with specificity where does it fall. Which one? 305B, 1, 2, 3, 4, or 5? We're going to get to that. It will matter. But just hold that thought. Okay? Question F. Assume that Hill has only one class of common outstanding, is also issued a series of 10% debenture convertible into common stock at the rate of one common stock for each $1,000 debenture. Hill makes an annual increase or an annual interest payment on the debenture holders, and 1 month later distributes a quote-unquote common stock dividend to the common shareholders without adjusting the conversion ratio of the debentures. Now, just keep in mind that if you look at 305D2, the term shareholders includes a holder of rights of convertible securities. Everyone see that? So are debenture holders, are they shareholders for our purposes? Yes. So keeping that in mind, everyone go to sleep for a moment. Everyone, well, you may say that's too easy to do. Sorry. Don't. Now the harder part, wake up. Do you feel any stronger? Those who, let's see how I can place this. If you're not a debenture holder, do you feel any stronger as a result, Larry? Guillermo, do you feel any stronger? Is this taxable? The answer is yes. And Howard, you're saying yes too. Why are you saying yes? And if so, why? Not because the conversion ratio hasn't been adjusted, right? The common shareholders are going to feel more powerful because the debenture holders the next morning have a right to less, right? And the common shareholders have changed their relationship to the corporation. They are empowered by this lack of, changing the conversion ratio. I'll give you a cite. The regulations, again, no one's being creative here. This is straight from the regulations, hint, hint. 305-3E. Example 4, I'll repeat, 305-3E, example 4, for the illustration that this constitutes a disproportionate distribution, whereas the debenture holders get interest, which is cash, and the common shareholders, because the conversion ratio hasn't been adjusted, have a proportionate larger increase in the corporate enterprise. So your answer for question F, taxable. Okay, taxable. 305B2. Well, there's a code section 305B2 which makes it taxable, where they have a proportionate increase in the enterprise. And regulation 305-3E, example 4, explains the rationale. Question G. Same as F, except that debentures are convertible into preferred stock. Okay, now it's convertible to preferred stock. The corporation declares a 1-for-1 split on the common stock, that each shareholder receives 1 new share of common for each old share, and the conversion ratio of the preferred is doubled. So you common shareholders, do you feel any stronger in the morning? Do you feel that your relationship has changed? If there's a simultaneous adjustment in the conversion ratio? And the answer is no. Any regulations? It's going to come as a shocker. Don't fall off your chair. Is that the examples under the regulations say the same thing. The authors, again, I don't want to say they're being lazy, but it's, again, very hard to change these fact patterns. So once again, regulation 305-3E, example 4, has another permutation which would say it's not taxable. So for your notes, if it's not taxable, Christina, what 2 code sections apply for that proposition? 305 and 307, right? Everyone agree? 305A and 307. Assume again that Class A and Class B are both classes of voting common stock. Hill makes a pro rata distribution of Class A on Class A and a distribution of newly issued non-convertible preferred stock on Class B. Atik, you've been waiting for this. Is this taxable or not, Atik? And if so, why? If so, why? Because Fatima would tell me you can't just say it's taxable and say 305B. Say slowly. D2 or B2? B2? Would you agree, Rafa? Michelle?
But I also think it's 305B.
Isn't it B3? Here's the issuance of common and preferred. Right, Michelle? Are we being told distributions of common and preferred? Change your relationship to that corporate enterprise, right? Making it taxable. What's the amount of tax? It's equal to the fair market value of the stock being distributed. 305B3. Right? There's a simultaneous distribution of common and preferred. Question I, same as H, except that the preferred stock which is distributed is convertible into Class B stock over 20 years at Class B's market price on the day of the distribution. So I think, Abu, you asked this question. Here's something that's convertible, but it's convertible over 20 years, and the conversion rate is at the fair market value of the date of distribution. Now, notice there is common and there is preferred being distributed, which might should give you a pause, suggesting that B3 might once again be taxable, right? Is it taxable here? Notice 305B5 talks about distributions of convertible preferred stock, right? Everyone agree? So when you're reading this problem and you're hearing about a distribution of convertible preferred stock, it suggests it's taxable, that 305A does not apply. However, the regulations, and I'll give you a cite, 305-6A, and if you look at the examples under 305-6A2, examples 1 and 2, say that if the conversion is such that it's likely that the preferred shareholders will all convert, so that it will all go from preferred to common, so essentially you're going to have just the issuance of common. It may take some time, but you ultimately will have 100% common, that preferred stock won't exist any longer, then it will qualify under 305A. Let me repeat that. In this problem, given the conversion ratio and given the long length of time, the preferred shares, right, Fatima, will likely all be converted over a 20-year period. Given the conversion ratio, given the long length of time, that this will not result in the issuance of common and preferred. That there will ultimately be this preferred stock outstanding. Where some people will have common, some people will have preferred, which will get us to where we don't want to be, because if you did have that, it would be subject to tax possibly under 305B3. So your answer for your notes is this is not taxable. However, if the conversion period, say instead of being 20 years, was 3 months, so it's a very short period of time, then some people might hold on to the preferred stock, some people might hold on to their common, and it would be taxable. Or alternatively, if the conversion was at some higher number. Instead of being at the fair market value, it was at fair market value plus $10 at a strike price that might not be reached. In that particular instance, it might be reached, it might not. Some people might convert, some people might not. That would not be a good sign. So your notes, the answer here is not taxable, but put an asterisk, in my opinion, that if the facts were toyed with, like in the examples in the regulations, this could result in tax. Look at examples 1 and 2 under 305-6A, because they give you an example one time where it's taxable, one time where it is not. Alan.
All right, so in that case, where it is taxable, would the exception 305B5?
Fine. Yes. Yes.
So like, just say.
Yes, it would be. If the facts were changed.
Yeah.
Under these facts,
Yeah.
not taxable, Christina would tell us 305A, 307. A, and what's written right next to 305 in your code is 307, right? I'm sorry? I'm not sure. What's your question? Okay. Let's look at question 2, guys. Question 2. C Corp has one class of common stock outstanding held by unrelated individuals. Why unrelated? Because we have to apply when it comes to redemptions. Code section, Irma, what code? 318. Thank you. So, Irma, we're not just going to look at actual ownership. We're going to also look at it by attribution. Right? And Wafa, you'll tell Irma that attribution comes up all over the place, right? Yes. Okay. Thank you. Will 305C create any tax problems if Z agrees to redeem 50 shares of stock at the election of each shareholder, and A makes such an election for 2 consecutive years? So, when we talk about redemptions, we always talk about before and after, right? So, because we have to see before and after if this shareholder had meaningful change in their ownership. We have 3 shareholders, A, B, and C, and we have a before and after. What percentage did A own before, guys? 50, and B owned 30, and C owned 20. Everyone agree? And we say that Z agrees to annually redeem 50 shares of stock at the election of each shareholder, and A makes an election. The other shareholders do not. Okay? So assuming that to be the case, what percent does A own after, guys? If 50%, how many shares does she own after? How much? Oh, not the 2, after the first. 450. Everyone agree? 450. And here's the question for the moment. Carolina, what's the denominator? 950, okay? Because I know next Saturday people are going to still stick with that 1,000, and you don't want to do that. Everyone agree? You must change the denominator. Can I be any clearer? That there's only 950 shares outstanding now, right? Everyone agree? So when you figure out the percentage ownership, it's 450 over 950, which is what percent? 47.4, right? And B and C go from 30% to where? 31.6 and 21%. Right? Because their interest in the corporation, they now own 300 shares out of 950. Everyone agree? Their ownership has gone upward. Now, if this were an isolated redemption, one-shot deal. First of all, would this qualify as a real redemption, or would this be taxable to A as a distribution, right? Because if this were Chapter 5 that we were talking about, that's the chapter we're in now, would this be true redemption, or would this be an exchange? Hannah? Hannah, what do you say? Gregory, what do you say? True redemption or an distribution? Say again, Gregory? Why? What's your authority? 302 what? B what? Say again, Hannah? B what? Can't be B2, can't be B3, right? If we get to the promised land, it's going to be B1 or nothing, right? Agreed? Don't forget what we just went over, guys, last class. If we're going to be here, it's going to be under B1 because we can't possibly fit under the other code sections, right? B2 or B3, and it's not B4. We're not told anything about the corporation partially liquidating. Do you think it would qualify under B1? I mean, B1's kind of murky, so, probably would. When he wakes up in the morning, A's not kind of feeling, weak, emasculated, right? Less than, can't control things here. And B and C probably would have no other tax effects associated with this. But now, we know this is a series of redemptions. So next year, A is going to have another, A, B, and C, A is going to have another 50 shares redeemed. So we take this, that becomes our B4, right? Everyone agree? This is after year 1. Everyone agree? This is at the year, and this must be at the beginning of year 2. Everyone agree? Just know your numbers, where they're coming from. I'll switch it up. I ask the other Hannah. Mercy, what do you guys say? What percentage now A is going to have another 50 shares redeemed? What happens? What percentage does A go to? Say again, Mercy? Okay, so you change the denominator. Everyone agree? We're going to change the denominator. It's going to be 400 over 900, which is what? 44.4%. B's feeling a little strong here. B's getting stronger. Right? A's going down, B and C are going up. Everyone agree? And at least as to A, this redemption may not qualify for exchange treatment, right? So isn't this, for a moment, use your imagination. It's almost as if A is getting a distribution taxable under 301, okay? Right? Getting cash. And what's happening to B and C as a result? They're getting the equivalent of stock, right, Ellie? They're feeling strong in the morning. So, in this particular instance, remember, Code Section 305C says that in certain instances, including redemptions, where some shareholders are getting cash distributions, hint, hint, A, and other shareholders are increasing their proportionate interest, guess what? B and C should have tax effects here. Now, you might say numerically, how does that pan out? Well, just take a look. We're not going to go through this whole thing now. Look at Regulation 305-3. Okay, if you want to take a look at your regs. -3E. And if you look at example 8, regulation 305-3E, everyone have that? If you go through this example at home tonight, it works on a Saturday night, I'm telling you. Okay? It really does. Is that, Jared, cancel the movie. Okay? Is that if you look at this example and you play out the numbers, there's a way to arithmetically figure out the equivalent of how many shares B and C are getting. Arithmetically, if you use some easy-to-apply algebra, which the regulations get you to, in their example, they are able to figure out what is X, which is 5.25 additional shares, and they're able to put a dollar figure on those shares. And by doing so, they're able to figure out the taxability, obviously in this example, but applied to our fact pattern of B and C as a result of this redemption. So we don't the numbers we're not provided with, we don't need to go through it, but I do want to call it yours. It's both examples. Well, just look at example 8. And this is the revenue rolling, Kevin, that you were referring to earlier. When I say the revenue rolling, I have to be careful of my use of language here. Revenue rolling 78-60, okay, where we have not just an isolated redemption, but periodic redemptions. The point is, once again, just like the lengths and our complicated case here, you can get into sticky situations where you say, gee, it's just a redemption. But no, all of a sudden this redemption transforms itself into something much more. It transforms itself into a taxable event to B and C. And B and C might say, gee, they're waking up in the morning, they haven't gotten any dollars. Allie would just say, gee, I still have my X number of shares. Why should I be taxed? But the reality is, when Allie's waking up in the morning, she's feeling a lot stronger now vis-a-vis her relationship to A. So that strength is a benchmark often when you're doing your yoga to saying taxability. Okay?
Professor, if it was the case that A only got the cash, but there was not a free from B and C, that's still right?
I don't know. I mean, are you saying there was a redemption or not? Because A did not get cash.
Because A got cash.
A got cash as a result of a redemption.
Oh,
But if it was,
if the percentage is 33% and the 22%,
that's always going to go up, right? When one shareholder is redeemed, everyone else goes up, right?
so we can say like one shareholder got cash, then there was a redemption.
Be careful, because one shareholder getting cash as a result of a redemption, if it's just an isolated event, it doesn't cause any other effects. Read the revenue rolling, read the example. It's if there's a series of redemptions. Okay? Now, last segment of the chapter, 306. And by the way, before we get into this, just look at problem 1A again on page 303. Everyone have that? What did we say? Taxable or not? Okay. Non-taxable. Now, suppose we were a cagey taxpayer. So you have non-taxable. You're 100% right. Not taxable, Code Section 305A. Now, suppose we're a cagey taxpayer, and what might we do if the company, in that case, had a lot of earnings and profits, and we issued this preferred stock to the shareholder? What might you do as a shareholder if you didn't want to get a distribution from that company? Because if you had gotten a distribution from the company, it would have been taxable as dividend income, and you had a big capital loss. So instead, you get this preferred stock, and under 307, right, Christina, you'd have some basis in the shares. You might take your preferred stock and sell it. Doesn't have to be to a related party. You could sell it to anyone, okay? typically what was done was it was sold to an insurance company, and let's say the fair market value was $100 of the preferred stock. And if you sold preferred stock, last I checked, you would have capital gain treatment, right? You sell it to an unrelated party. We don't have to worry about attribution rules. And then 10 days after we sold it, we bought it from the insurance company, redeemed it, right? When I say we, I got to be careful of my own pronoun use here. The corporation redeemed the preferred shares from the insurance company, paying a small premium, right? The insurance company doesn't want to get involved unless it's going to make some money. So you pay the insurance company $1, so it's $101. We redeem it. The insurance company walks away. It was a facilitator. And the whole transaction disappears. And wasn't that great? We issued preferred stock. It was not taxable. We sold our preferred shares, got capital gain treatment. The insurance company was happy to get paid a small fee for buying the shares and then having them redeemed. And everyone is happy but for the government, right? Everyone's smiling but the government, right? Everyone see the game? Issue preferred stock. Preferred stock doesn't have voting rights and all those other things that can get ugly. So let's give them something that, even if the insurance company subsequently became recalcitrant, who cares? We'll just, they don't have any say in the company, so we limit our exposure that way, right? So we issued the preferred stock, and it's all good, except for the government. So, and there was a case, Chamberlain, that the authors talked about, and I don't know, someone said they had the 7th edition, the prior edition to this book, and the whole Chamberlain case is in, anyone have the prior edition? You'll see the Chamberlain case is in your book, but it ain't there anymore, okay? There's just a cross-reference to it. The Chamberlain case on page 304, under 306 stock, the second paragraph, footnote 1. The Chamberlain case said, this worked. The Chamberlain case said, gee, who are we to say it doesn't work? There's nothing in the code to stop it. Even though we know it's kind of gamesmanship, there's nothing that says it can't work. So Congress, as Congress is apt to do, once it learns of a family secret, so to speak, it could come back and rewrite the code, which it does. And now we have 306, Code Section 306. If you want to open up your code, let's look at it together. Okay. What is 306 stock? Might as well start there. 306C1 says, what is 306 stock? For purposes of this chapter, section 306 stock means stock which meets the requirements of A, B, or C of this paragraph. And for our purposes, A says distributed to seller. It's stock other than common stock. Notice that parenthetical. Essentially, for our purposes, guys, for exam purposes, it's preferred stock, okay? Which was distributed to the shareholder, selling or otherwise disposing of such stock if, by reason of Code Section 305A, any part or such distribution was not includable in the gross income of the shareholder, right? So we have 306 stock. Typically, if it's stock on stock and the stock you received, if the stock Ellie had, that second piece of paper said preferred stock at the top, unless an exception applies, it is 306 stock. It is stock with a taint. Now, Congress could have been could have been impatient and said, hey, if you get 306 stock, it's taxable immediately. but Congress decided not to take that position. So when people dispose of their 306 stock, that can either happen upon a sale or upon redemption. So 306A talks about, A1 talks about dispositions other than redemptions. It says, if such a disposition is not a redemption, the amount realized shall be treated as ordinary income. You see that? So when you sell your 306 stock, the whole thing is ordinary income. But then there's a carve-out. This subparagraph shall not apply to the extent that the amount realized exceeds such stock's rateable share of the amount that would have been a dividend at the time of distribution if, in lieu of Section 306 stock, the corporation had distributed money in an amount equal to the fair market value of the stock at the time of distribution. Paraphrasing that, what that says is you will have ordinary income essentially when it comes to a redemption. Okay. If it is not a redemption, rather it's a sale, you look back. It's a look-back rule. If it's a sale, and you see the pro rata amount of earnings and profits available, and that becomes the ordinary income portion. Let me repeat. That when it comes to a sale, look back and see what was the available earnings and profits at that time, and if cash had been distributed and it was or would have given rise to ordinary income or dividend income, that portion will be treated as ordinary income. So when it comes to non-redemptions, it's a look-back rule. Let me repeat. Non-redemptions, look-back rule. When it comes to redemptions, look at current existing earnings and profits. If you look at 306A2, it says, if a disposition is a redemption, the amount realized shall be treated as a distribution of property to which Code Section 301 applies. So that means that it will be treated as, under 301, you look at current and accumulated earnings and profits at the time of the redemption. Now, there's certain exceptions to 306T, spelled out in 306B. If you terminate your interest, and that's 306B1. If there's a liquidation, B2. B3, if there's gain or loss not recognized. B4, if the transaction is not for tax avoidance purposes. So essentially, Code Section 306 is trying to police the gain of where preferred stock was issued and trying to look at the consequences if you have 306 stock, if there's a sale versus a redemption. Let me repeat, for your notes, for your outline, for the exam, make sure, one, you can identify what is 306 stock. Let me just tell you, in years past, I want to, again, talk through the paper, disrupt your summer vacations, but I can't, good news for you, and say, guys, were we here together on a Saturday morning or whatever day I was teaching in the past and say, did you forget? Were you overwhelmed? Why didn't you see this being 306 stock? So anytime you see preferred stock being issued, your antenna should go up. Is it 306 stock? Because there's going to be special implications. And if you don't see them, now I asked one of my short answer questions on 306 stock, and you blow through it without recognizing or identifying 306, it's not a good day for you, and it's not a good day for me. I have failed in my mission. So everyone with me? Everyone's going to be able to identify what is 306 stock, right? Next, once you identify, you're already 90% there. Because once you identify it, you just have to then categorize it. Is there a sale or is there a redemption? Because if you can identify if there's a sale or redemption, two different rules apply, and you either look back or you look at the present. So what the authors do in the textbook is that they talk about the history, again, without going through the whole Chamberlain case, which was once here. They talk about the difference between a sale and redemption. They talk about what is 306 stock and distinguish it from common stock, which for exam purposes, it's not going to be hard. I'm not going to trick you on this. I'll either say preferred or common. It's not going to be where, gee, I'll try to mix it and won't identify even the stock. I'll identify. And what's bad, I feel badly, is even when I say preferred stock, it doesn't stop people from not recognizing or calling it 306. So, okay, so please, make sure next to 305, right, you have down 307, but in big letters, or big numbers, I should say, please put down 306 as well with a question mark, because if we're dealing with 305, you should at least call to your attention, does 306 apply, right? And on page 309, once we identify what is 308 talks about the tax implications, which we'll look at in a moment. By way of example, page 309 talks about dispositions exempt. Okay, we talked 306B are certain exceptions, right? We have our general rule, and then Code Section 306B provides certain exceptions when Code Section 306 won't apply. And then, no matter how many years I teach this course, I can still never pronounce. I'm at least consistent. On page 3010, 310, help me not to say next year I'll even be able to attempt. How do you pronounce this case? Fire-oved? Fire-oved? It's kind of a weird name. Okay? On page 310, we go through an example where first 305 applies, and the person gets issued preferred stock, and then subsequently the company redeems the preferred stock, right? And is this stock 306 stock? Is it 306? 306 is preferred stock, right? And anytime you hear the word preferred, your antenna goes up and you think, 306. And the taxpayer is trying to take the position like Chamberlain. They subsequently dispose of it, and they want to take the position they had capital gains, right? And at the district court level, the taxpayer is successful. Taxpayer is successful. By the way, just be forewarned, what happens this week, guys? Yeah, the Supreme Court. We got some big decisions coming out this week, so I'm sure everyone's going to be glued to their radios, TVs, or whatnot, the internet, as the Supreme Court comes out. So there'll be some excitement in the air. All right. So what this court opinion does is it begins on page 311 with the background of 306, why Code Section 306 is necessary. And the court has to investigate whether or not, remember, an exception to this applying, Code Section 306 applying, is whether or not one of the purpose, let's just, I don't want to even paraphrase it, 306B4 says, if it is established to the satisfaction of the Secretary that the distribution and disposition or redemption, and then you go to the flesh language, was not in pursuance of a plan having one of its principal purposes the avoidance of federal income tax. So the taxpayer would like to rely upon this for the proposition that 306A should not apply because it was not pursuant to a plan having one of its principal purposes being tax avoidance. That there was a business motivation underlying this. Is the taxpayer successful? The taxpayer is not successful, at least in the appeals court, because on page 313, the third paragraph down, I repeat, on page 313, the third paragraph down, the second to last sentence says, Mr. F decided to take the stock dividend rather than to distribute cash to himself as a dividend and then to make the loan to the corporation of the necessary money, because if he took the cash, he would subject himself to taxation at ordinary income tax rates. So he was savvy enough to say, no, don't give me the cash, I'll take preferred stock. So there was a tax-motivated reason to taking the preferred stock in lieu of cash would save him tax dollars. So this is not a compelling argument that one of his principal reasons was not tax avoidance. Subsequently, he sold a portion of his common stock. In other words, he sold a portion of his common stock. So he said a portion. Remember, when you terminate your interest in the corporation, if you terminate your interest, you don't have to worry about Code Section 306 applying. That's under B1, 306B1. So suppose you terminate your interest as to 25%. Can you at least say as to 25% of your preferred stock that it qualifies for exchange treatment? And the answer the court says is no. That in this case, it was not a termination such as envisioned by the court. And we'll go through a problem or two that elaborates this issue. But at the end of the day here, the taxpayer loses. It's because we're not going to look. Typically, 306, when you look at 306 stock, generally, if the company at the time that 306 stock has earnings and profits, if the company that issues preferred stock has earnings and profits, and it doesn't distribute cash and it distributes stock and it qualifies under 305A, is that going to save the taxpayer money? And the answer is yes. Is it going to be 306 stock? Yes. I don't care if there is a business motivation. If it saves tax, it's going to be hard to argue it's not tainted stock because there's no tax avoidance motivation. And we'll talk a moment when we go through the problems whether or not a partial termination can ever help the taxpayer. All right? So it's not the most important case, but let's go through, because we only have a half an hour left, and I want to get through the problems on page 316. We have in year one, a corporation distributed non-convertible, non-voting preferred stock worth $1,000 to each of its two unrelated equal shareholders, Jason and Vera. Okay? Now notice, it uses unrelated, and that may play an important role here. The A common stock each owned, the common stock owned by each of the shareholders had a basis of $2,000 prior to the distribution and a value of $3,000 immediately after the distribution. At the time of distribution, A had $2,000 of earnings and profits. In year three, A had $3,000 worth of earnings and profits. Okay? So, again, A corporation, a non-convertible, non-voting preferred worth $1,000 that is going to distribute to two equal shareholders. Common stock owned by each had a basis of $2,000. I should write some of this out. So the fair market value of the stock being distributed is $1,000. The adjusted basis they had was $2,000 in their common stock. I'll put C as in common stock. And fair market value equals $3,000. And this is the preferred stock. time of distribution, the corporation had $2,000 of earnings and profits. So the E&P is $2,000 at the time of distribution. Let's just say in the year 2012, and then at the time in year 3 years later, let's say 2015, just to make it easy. E&P was 3,000. All right. What are the tax consequences to Jason Vera and the corporation of the distribution of the preferred stock in year 1? Okay, so year 1, preferred stock is being distributed. In this case, is it taxable or not, JP? Akash, is it taxable or not? What do you guys say? Taxable or not? Marlene, taxable? Not sure? Not taxable. You say not taxable. It's your authority. 305A, right? Right, Allie? You're not feeling any stronger. You just have another piece of paper in the draw, right? Everyone agree? The shareholders should not feel any stronger as a result. Vis-a-vis each other, they have not changed their relationship here. And if Christina was here, she'd tell us 307, right? And since, John, you raised it before, I've got to come back to you. How are we going to apply 307 here, John? Because now we have two shareholders, right? We have Jason and Vera, two shareholders in this entity, right? We have Jason and Vera, each own stock in A. And now, just instead of owning common, they have another piece of paper, but they need to know their basis in this piece of paper, right? Don't say it out loud. Tell me, everyone, take 1 minute. I'm going to look at the clock. Figure out what your basis, and then I'm just going to go down a row, arbitrary row, and I want to know what you say your basis and your preferred and common is. It started at 2,000 in your common, but now we own two pieces of paper. We need to know. John, do you have an answer? Is it a yes or no? Adele? Yeah, two pieces of paper. What's their basis in each piece of paper? Adele, one thing you may not know the basis as to each piece of paper. What do we know must be the total basis of the two? 2,000. Everyone agree? If you come up with, a basis in the preferred stock of 5,000, a basis in the common of 3,000, totaling 8,000, you know you're wrong. Congress is generous, but not that generous. So we know we got to keep with the $2,000 basis, right? And it's just a matter, right, Jean, of divvying it up based on what? Okay, what's the aggregate fair market value? 4,000, right? Everyone agree? So we had to divide this $2,000 up. The common, how are we going to divide this basis? 2,000 times what's our numerator and denominator? And what's our preferred? Voila. Nothing complicated. That's it. Just divvying up based on fair market value. Now we have two pieces of paper. We have a basis in each. Everyone agree? Gregory, you agree? Yes? Gregory, you got that? You don't have it. In other words, we know that we're going to take this $2,000 basis, and now we have two pieces of paper. Code section 307 says we have to take this overall basis. That's what the investment is in the company. Each one of these shareholders invested $2,000, right? I mean, they could have had that basis under Code section 358. They could have had it under Code section 1012. Doesn't matter for our purposes. But now, they originally had a $2,000 basis in this piece of paper. Ali, hold up that piece of paper. They originally had a $2,000 basis in that piece of paper, right, Gregory, and one piece of paper. But now Ali has two pieces of paper, right? And she needs to know her basis in both, right? And Code section 307 says, look, start with your overall basis and divvy that up based on the fair market value, which we're told is $3,000 after the distribution, over the whole value, which is 3 plus 1. Multiply that, and it's got to equal $2,000. And the authors could have introduced this, truth be told. Remember the first half of this chapter, they talked about Code section 305A. We never even, we spoke generally about Code section 307. We never went through an example, right? And for the first time, we're really seeing Code section 307 numerically being illustrated, demonstrated. Hold on. Not divided by the adjusted basis. But that's not going to work.
I get the same thing.
No, you got to take you're just divvying up this $2,000 by a fraction, based on the fractional fair market value of each. So your answer today, guys, is no tax, 305A. The basis gets divvied up. And Corporation A has no gain or loss on its issuance of its own shares, right? Because remember, A is issuing preferred stock, right? And when a company issues its own shares, even Code section 311, which can be the nemesis for taxability to a corporation, 311A specifically says when a corporation issues its own shares, there's no tax. And any effects on the corporation's earnings and profits by issuing these shares? No. Code section 312D1 says there's no effect on earnings and profits, okay? So everyone have in their notes, the only thing that's going on here is to the shareholders, no tax, 305A, basis being allocated, 307. The effects to the corporation are non-existent. 311 doesn't tax, 312 no adjustment for earnings and profits. Right, Matt? You want to cover both the tax and the E&P. All right. Question B. What results to V and A if V sells her preferred stock to Carl? That's an unrelated person. Carl is not related here. For $1,000 in year 3. So now Vera is selling to Carl, some guy in the street, for $1,000. How would Vera like to report this? Not to say it's right, but how would Vera like to report this? Capital gain, right? Under what code section? 1001, right? 1001, okay? Vera's feeling good. Vera's feeling 1001, 1221. Vera would like to report 1,000. right? Jean less her $500 basis. Shirley, can she do that? Can Vera get what she wants? Can't get what she wants? If not, what happens here? Is this tainted stock? Yes. Tainted stock under what code section? 306, right? And how do we know it's tainted? It's preferred stock, right? Everyone agree? Let's go back to our definition. Code section 306C1 says it's other than common, right? And by reason of 305, any part was not taxable. So it's 306 stock. Now, given that it's a sale, don't say it out loud. Hesitate. I appreciate your enthusiasm. Everyone think to yourself, do you look back or do you look at the present? Don't say it. Do you look back or do you look at the present? Do you look back or do you look at the present? Chloe, do you look back or look at the present? Angie, agree or disagree? Yes. Gary, Angie, you look back or look at the present? You look with saying what? Just say it out loud. Saying that. Gary agreed? So you disagree? Angie, you want to change your answer? Because you agree with Chloe, then you're changing your answer by default. Which means you would be right then. Because you got to look back, right? When there's a sale, you have to look back. Everyone agree? This is not a redemption. We're selling it to an unrelated party. And that being the case, you have to look back. Now, having said that, how much was earnings and profits when we look in the rearview mirror? 2,000. And do we look at the pro rata amount or all 2,000? It says pro rata, not all of it. We look at the pro rata amount, and we have a 50% shareholder. So it would be, we would look back at 1,000. Now, instead of getting preferred stock, we had gotten cash, what would have happened here? There would have been a dividend as to the whole. Everyone agree that we would have had $1,000 worth of dividend income, right? So that being the case, what happens here? Do we get a loss? Because we had a $500 basis, but code section, look what it says here. 306A1 says the entire amount shall be treated as ordinary income, right, which is $1,000. But we had a $500 basis, so did we get a $500 loss? And the answer is no, we do not, okay? You do not get a loss. 306A1C says no loss shall be recognized. Does our basis disappear? No, our basis does not. Where does it go? Back to the common stock. So the answer here is 1,000 of ordinary income, and the basis of 500 floats away to the common stock. So now our shareholder would have a $2,000 basis, Vera would, in her common stock. Now, take a look with me, guys, because this is an important example. Look at 306-1B2. Everyone have 306-1B2 open? Example 1. Example 1 says A and B owned all equally the stock of Corporation X. Everyone have it? 306-1B2, example 1. A and B owned all the stock equally of X Corporation, which files an income tax return on a calendar year basis. On that date, Corporation X distributed pro rata 100 shares of preferred stock as a dividend on its outstanding common stock, okay? That's 306 stock, right? On December 15th, 1954, the preferred stock had a fair market value of $10,000. On December 31st, 1954, the E&P of the company was $20,000. Okay, they're giving us a hint because subsequently, look what happens. The 50 shares of the preferred stock distributed to A had an allocated basis under 307 to him of $10 per share, or a total of $500 on the 50 shares. I added the 307, but that must apply. Such shares had a value of $5,000 when issued. Well, we would need to know that because by knowing that, Jean would tell us we now can do our ratio. A sold the 50 shares of preferred stock in 1955 for $6,000. Of this amount, $5,000 will be treated as ordinary income. Why $5,000? Because that's the pro rata share that when we look back would have been available as earnings and profits. $500 would have been the $5,500, which is the $5,000 ordinary income plus the $500 basis, be treated as gain from the sale of a capital asset. If you go through this, now listen, it's tough for you to follow on this, okay? I admit, it's tough to follow. But my message to you is, please, if you want to get a better handle on Code Section 306, if you look at this example 1, and you take your time, and you read it 2 or 3 times, if you don't understand this example, let me make this observation. You're going to have a tough time on the final exam. So you got to struggle with it. I don't think the struggle is going to be that hard. Now, if you read example 2 and you struggle with it, I think you'll be able to get it. And if you read example 3 and you push yourself, I think you'll be able to get it. But you owe it to yourself, because if you want to do well on the exam, if you read these 3 examples, you're going to be on the path to victory. And when I say read them, and understand them. But if you read them and you don't understand them and say, well, he probably won't ask a question on this, you're wrong. All right? I will. And I'm trying to be clear because I want to have a good summer. All right? And I'm only going to have a good summer, if you guys do well. All right? So help me, help you, help our mutual summers all together so we can all have a great summer. Read these examples and really struggle with them. I hope you don't, but work at them so you understand them. Now, this is stuff you're going to see on the final, so I don't want to rush through this. So I want to spend 5 minutes just talking to you about the last chapter, and we'll start class assuming you struggled and then succeeded and felt good about your struggle and success. We'll revisit these problems on page 316 rather than rush through them. Do not worry about problem 2b on page 317. Do not, because I'll be happy if the real thrust of the questions here are on page 316. Okay? Let's turn our attention. Don't close your books. Give me a few minutes just to help you with chapter 7. It's an important chapter, and once again, no secret, there will be many questions about corporate liquidations, okay? So let me try to give you a little bit of framework to understand this. Code section, or chapter 7, deals with complete liquidations. And just open your code, because getting oriented here, I think will be very useful. Look at code section 331, okay? And notice right what's above code section 331. So open up to code section 331. Right above it says effects on recipients. Everyone see that? What that means is code section 331, we can have our general. We have two different variations here. Code Section 331 is entitled Gain or Loss to Shareholders in Corporate Liquidations. And 331A says amounts received by a shareholder in its distribution and complete liquidation of a corporation should be treated as full payment in sale or exchange. Okay, everyone see that? So 331 applies at the shareholder level. Agreed? What do you think if we have a parent subsidiary? Okay? Guess what? 332 is entitled Complete Liquidations of Subsidiaries. And notice the vast contrast. Okay? No gain or loss shall be recognized on the receipt by a corporation of property distributing complete liquidation of another corporation. So 331 is taxable, 332 is not. And notice, if you don't identify one versus the other, it's not a promising start. Everyone agree? This is a parent subsidiary. Notice the circle. This is not a parent. This is a person or a non-corporate shareholder.
Yeah, which one you say tax apply and which one you say not?
This is taxable, non-taxable. When a corporation is liquidated, and I know I apologize, I didn't bring any tissues. So I know people kind of feel sad, liquidation, it's termination, but no tissues. When this corporate entity gets liquidated, we get property. Everyone agree? We all get when I say we, pronoun, I got to be careful. This person gets property, right? This entity no longer ceases to exist. And it may have tractors in it. It may have cash. And the same is true here. So when these enterprises are liquidated, guess what? This gets property and this gets property, right? Everyone agree? Everyone have that visual? In other words, if I took an eraser to this, which I won't for the moment, this gets erased and this shareholder now owns the property of the corporate enterprise. And I know a question at the tip of everyone's tongue is, well, what basis will S have in these assets, and what basis will the parent have in its subsidiaries' assets, right? Everyone wants to know that, right? And if you had to put your best foot forward, you would say, what basis does S have in the property here? Fair market value, right? Because this was a taxable event, it will have a basis of fair market value. What basis do you think? Carryover. You guys are 12:25 on a Saturday? It's great. All right? And look, 334A and 334B tells you or just affirms what you thought, which is great. Now, that's half a look, right? You guys want to know, I assume you do, who won it. What is the effects on the corporate enterprise? And look at right above Code Section 336. It's entitled, right, Christina? Effects on corporation. Not the shareholder corporation, not the parent, because we're talking about at this level. And look what 336 says. Gain or loss recognized on property distributed in complete liquidation. Does this have an aroma we're all familiar with? Somewhat of a similar aroma? What kind of aroma? It's different, but somewhat similar. Which is what, Christy? Okay, but you're compared to what code section? 311, right? This has some half the analogy, but under code section, instead of 311, 336 says gain and loss shall be recognized. But Christy, do you think Congress is a little nervous when it talks about losses? Yes, and if there's a challenge here, 336D which talks about limitations on losses. Are you surprised? Anyone falling? I didn't see anyone fall out of your chair. That when it comes to limitations on losses, are we surprised that Congress is a little bit nervous, right, when it comes to losses? Agreed? And if there's a challenge, and I'm going to tell you right now, if there's a challenge in our next chapter, that's it, 336D. Agreed? Because, we could be done with our next class in about 20 minutes if I just said, all gains and losses recognized. But Congress is nervous that taxpayers might game the system when it comes to losses. Everyone noticed, though, because Christie's pointing out the parallel, if this were non-liquidating, 311 applies. Agreed? But we're in a different world, different dimension. We're in a liquidation context. 336 is a very different code section, right? Now, when it comes to the liquidation of a subsidiary, is gain and loss going to be recognized? What do you think at the corporate level? And what's your authority for saying no? 337. .337 is going to say non-recognition. Notice the vast contrast between 336 and 337. Everyone see that? One is a recognition provision, one is a non-recognition provision. And that's the whole chapter, guys. When I say that's how this chapter is framed, the first part of the next chapter is this, okay? This picture, agreed? Where you had this liquidation happening. And the second part of this chapter is liquidation of a subsidiary into a parent. Now, any professor who didn't let his students out early on a beautiful Saturday morning would just be complete ogre. So given the fact I'm letting you out early, do not put that name on me. You're out early. I'll see everyone on Wednesday.